Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of today's biggest corporate filings. And let me tell you, Motorola Solutions has some juicy details in their latest 10K report. Get ready because we're about to decode a year of big moves, especially with some impressive acquisitions. So Motorola Solutions, the company you know for making public safety and security tech, has just dropped its annual report and it's packed. They are all about keeping communities and businesses safer with their tech, from radios to video surveillance to command center software. They are pretty clear about their mission solving for safer, they call it. And they back this up with a global network of over 100,000 customers in more than 100 countries. Now, let's get to the money. They break their business into two main parts: products and systems integration, and software and services. In 2025, the products and systems integration part brought in $7.3 billion, which is a big chunk, 62% of all their sales. This is where they sell things like their mission critical radios, those fancy body cameras, and the systems that tie it all together. Their mission critical networks, or MakeCN, which includes their famous two-way radios and newer broadband tech, made up a massive 84% of this segment's sales. This shows how much their core radio business still drives them, even as they push into newer areas. The other half, software and services, raked in $4.4 billion in 2025, making up 38% of sales. This is their growing area, focusing on things like software for their command centers and video management, plus support and cybersecurity services. Their MCN services here were a huge part, 58% of this segment's sales, showing they are earning money not just on selling the gear, but on keeping it running and secure for the long haul. Looking at the overall results for 2025, Motorola Solutions saw a solid increase in net sales, hitting $11.7 billion, an 8% jump from 2024. Their operating earnings also went up, reaching $3 billion, and their net earnings attributable to shareholders. That was $2.2 billion or $12.75 per share. That is a significant jump from 2024, where earnings were $1.6 billion or $9.23 per share. This growth is great news for shareholders, showing the company is becoming more profitable. Their overall gross margin, basically how much money they make after directly paying for the goods or services they sell, is looking strong. It was 51.7% in 2025, up from 51.0% in 2024. This means for every dollar they sell, more than 50 cents is left over to cover other costs and make a profit, which is generally a good sign of efficiency and pricing power. This improvement was helped by higher sales and lower direct material costs, even with some tariffs. Now, what about those other costs selling? General and administrative expenses, or SG&A, went up by about 7% in 2025 compared to 2024, reaching $1.87 billion. This increase is mainly tied to higher employee incentive costs, including stock-based pay and expenses from the businesses they acquired. But here is the interesting part. Even though SG&A went up, it was a slightly smaller percentage of their total sales in 2025 at 16.0% compared to 16.2% in 2024. This suggests they are managing these costs pretty well against their growing sales. They are also pouring money into the future. Research and development, or R&D expenditures, increased by 6% to $970 million in 2025. This is crucial because in the tech world, you have to keep innovating. Around 40% of their global employees are in R&D and engineering, showing a strong commitment to developing new products, including a big focus on artificial intelligence, or AI. Then we have other charges. This number jumped significantly in 2025 to $207 million, up from $155 million in 2024. A big reason for this was higher costs for amortizing intangible assets, mostly from their recent acquisitions and more money spent on acquisition fees. They also had some reorganization costs. But they also recorded a big gain in 2025 from the Hydra litigation, which helped offset some of those charges. Speaking of Hydra, that legal battle is still a major story. In 2017, Motorola Solutions sued Hydra for trade secret theft and copyright infringement. A jury initially awarded Motorola about $543 million plus interest and fees. The fight has been going through appeals, and in 2024, Motorola got about $61 million that was held in escrow. In 2025, Hydra made another $157 million in payments towards the damages, with Motorola receiving $141 million after taxes. This is still ongoing, with rulings expected in early 2026 on royalty payments and asset turnover. And on the criminal side, Hydra pleaded guilty to conspiracy to steal trade secrets in January 2025. While this legal saga has been long and complex, the financial wins from it in recent years are clearly impacting their bottom line, as seen in those gains from the Hydro litigation. Now, let's talk about those big acquisitions. In 2025, their investing activities showed a massive $4.6 billion increase in acquisitions, and investments largely due to paying $4.4 billion for Silvus Technologies in August. They also acquired Blue Eye for about $79 million and Theatro for $174 million. These acquisitions are clearly a strategic move to expand their offerings, especially in areas like mission, critical networks, and video security. Silvus, for example, brings advanced mobile ad hoc network or MANET technology, which is super important for secure communications without fixed infrastructure. With these big buys, their debt naturally increased. Outstanding debt grew to $9.2 billion in 2025 from $6 billion in 2024. To fund these acquisitions, they issued a lot of new debt, including $2 billion in senior notes in June 2025 and borrowed $1.5 billion in term loan facilities in August. This means they are using leverage to grow, which is common, but it also means they have a larger interest expense. We see their interest expense net jumped from $227 million in 2024 to $302 million in 2025. A pretty direct result of taking on more debt. Overall, the company is growing with net sales up 8% in 2025. The software and services segment showed particularly strong growth at 13%, while products and systems integration grew by 5%. This indicates a healthy balance with both parts of the business expanding. When we look at their risk factors, they are pretty upfront about the challenges. They are heavily exposed to cybersecurity threats, supply chain disruptions, and the complexities of global operations and regulations. They also highlight the risks associated with integrating acquired businesses, which is very relevant given their active acquisition strategy. The success of these integrations and the ability to realize the expected benefits will be key to their future performance. On the financial side, their pension plans are quite underfunded, with a benefit obligation of $3.865 billion for US plans and $1.211 billion for non-US plans at the end of 2025. This means they owe more in future retirement benefits than the assets they currently hold to pay for them. While they are making contributions, this remains a significant long-term financial commitment. The company's investment strategy for these plans aims for an 8% return on assets, but market volatility could impact this. Looking at the big picture, Motorola Solutions has had a strong year in 2025. Sales are up, earnings are up, and they have a record backlog of $15.7 billion. Their strategic acquisitions like Silvus are integrating well and contributing to growth. The company's core mission. Critical communications business remains robust, and its expansion into video security and command center software is paying off, especially with the increasing demand for integrated safety and security solutions. However, they are carrying more debt, which increases their financial risk, especially if interest rates climb. The pension shortfalls are also something to watch over the long term. The company's leadership, including Chairman and CEO Gregory Q. Brown, seem focused on navigating these challenges while continuing to innovate, particularly in AI and integrated solutions. One area that deserves constant attention is cybersecurity. Motorola Solutions is implementing robust risk management and strategies, including regular assessments and third-party analyses, which is essential given the sensitive nature of their customer base, which includes public safety and defense agencies. Despite these efforts, the evolving threat landscape means this will always be a critical area. The Hydro legal situation, while providing some financial recovery, is a stark reminder of the ongoing competitive and legal battles in their industry. The fact that it is still dragging on through the courts, even after a criminal plea, shows how impactful these disputes can be. In conclusion, Motorola Solutions is a growing company with a clear strategy focused on integrated safety and security technologies. They are making smart acquisitions to bolster their portfolio and appear to be managing their operational growth effectively. The financial health looks good with solid sales and earnings growth. Though the increasing debt and the long-term pension obligations are points to monitor, the company's direction seems solid, leveraging its established brand and technological prowess into new and expanding markets. What is your take on Motorola Solutions' latest annual report and their strategy moving forward? Let us know in the comments below. If you found this deep dive valuable, please hit that like button and subscribe to Corporate Decoder for more breakdowns like this. And don't forget to join our Discord community, linked in the description, to keep the conversation going. Thanks for watching, and we'll see you in the next video.